Welcome to the Possibility Action Network podcast. I'm your host, Stephen Middleton, aka Possibility Man. We're committed to bringing you guests who strive to better people's lives and serve as a force for good in the world. Our guest today is Malnik. He's the founder and chief wealth strategist for Malnik Wealth Management. The Malnik team consists of a father and his son, Josh. Their combined expertise and dedication to their clients have allowed them to navigate uncertain times and various economic cycles, ensuring that they protect and grow their clients' investments. As Leon says, we start by forming friendships with our clients, and they eventually become like family. Leon Malnik, welcome to the show today.
Thank you very much, Steve.
All right. I'm excited to have you here. And first, I want to make this announcement to our listeners and our viewers. Follow, like, and share this podcast wherever you find it. Your support matters and is appreciated. Hey, Leon, podcast hosts say this all the time, but I really want people to know that their support matters and is appreciated. Got a question for you. What was your profession before you got into investing?
Well, I've always been in financial services. My first job was in risk management. I worked in property casualty. I had a license in life, health, and disability. I did that all at once, and that was back in 1972, 73. And I maintained that till about 1980, and I decided I would move straight into the life insurance business, and I started to follow a lot of doctors around and sold them a lot of disability insurance. So I went from property casualty kind of to life and health, and that kind of migrated into group insurance. I'm in the Maryland, Washington, D.C. area, Virginia, and it's either kind of the government or small businesses. And I was mostly with small businesses, and I marketed group insurance plans. And I did that till about 1991. I was pretty successful. I had a lot of groups, like 60 different groups, most of which were small, 25 and less. And then Hillary Clinton kind of threw me for a little bit of a loop, because I had my first house, I had my first daughter, and she was going to nationalize health insurance, as you remember. She didn't. She was not successful. Obamacare came out many years later. But my fear was I was going to lose all my group insurance. I said, what am I going to do? I got all these obligations, new family, new baby. And I started to think, and I came up with the idea that I would market to my groups 401k plans. Well, I needed a securities license in order to do that. And that's how I got my toe in the water of the securities business. And I found that I liked it a lot more than risk management.
Yeah. Well, it sounds like when you came out of secondary school, let's say high school, were you thinking about financial services at that time, or the financial services like kind of drip on you in your early 20s?
My life would, if I could characterize it, was more like a pinball in a pinball machine. I went to school and my area of interest was history. And then when I finished the University of Maryland, I looked around and I said, I don't want to teach history to kids who aren't interested in it. And I went away for a year, worked in a kibbutz, and came back and got this job in this insurance agency. It was actually real estate and insurance, and I went on the insurance side because we were having a downturn in the economy and nobody was selling any houses. All the veterans were walking around, and the manager of the insurance business said, look, see, these guys are all unemployed. But if you had insurance business and you sold somebody a homeowner's policy, they would renew it the next year, and then you can add to that with a new one. So I said, I like that idea of a business model, gives me residuals.
uh,
And ever since
yeah.
then, I have tried to maintain a business model that has residuals because I
Uh-huh.
believe that if you're not making money while you're sleeping, you're going to have to work the rest of your life.
I understand. Hey, so you mentioned that 401ks were your first product. What got you into stocks?
Well, from when you manage as a fiduciary 401k plans for groups, they're putting their money into mutual funds, and that just and to this day that's the model. So that kind of got me interested in financial services and in investing. And I did it for a good 10 so years. And then I joined a company called LPL. And I kind of broke away and just began to sell individuals and companies stocks and bonds. And that's pretty much how it kind of catapulted.
Okay. So how did you, let's say, I mean, I know that you are a skilled investor today because I've talked to some people who work with you. How did you develop the skills of investing, your skills as an investor?
That's a great question. I ask myself that all the time. It's just hard work, day to day reading, learning how to rebalance income statements, listening to a lot of different information, and try to distill it down to reading tea leaves that will allow me to predict the future. And let me give you
Mm,
an example in real sense how that means. In 1981, I got my first computer. I took it apart. It's called compact. It was a big old thing. It was just this big. It was called portable. It was big. We used to carry it around and roll it around on a wheeler. And so I took it apart and I got inside it. Not because I wanted to care about what was in the computer. I wanted about the computer. I wanted to know who were the companies that were producing these magical little instruments that could do things that had never been done before. And those
mm,
same companies are around today. Companies like manufacturers like Dell, Asus. I mean, you'll go on the computer, Nvidia. They were there, and so I began to get interested. My area is tech. I like that a lot, and so I kind of grew with that, and I saw which was practical, and I believe that my mind um, in the days of old, what was important was gold. Today, what's
mm,
important is data. Data
uh-huh.
is the gold of yesterday. And so I just followed the money of where the data is being moved, organized, facilitated.
Yeah.
And that got me into learning about investing in those companies.
Uh-huh. Yeah. You mentioned the 1980s. I want to come back to that in a moment. But I want to ask a few technical questions, kind of technical questions that about words that we hear about, but many of us don't understand them. For example, we live in the United States. This podcast is shown up around the world, but we live in the United States, and the word or phrase Wall Street means something to a lot of people who live here. What's Wall Street? What is that?
That's exact. It's a road. It's got the name
Uh,
Wall Street.
uh-huh.
That's what it
Yeah, yeah,
is.
yeah.
And yeah, it's if you go in front of the exchange, um, that's the road that intersects it, Wall Street.
Yeah, yeah, yeah. So
So
the
that's what
stock
it came from.
market.
It came from the name.
Yeah, I got you. So, we all talk about the stock market, but of course, it's simply on Wall Street. And today, some people use the term Wall Street to be synonymous with the stock market.
It's
Yeah,
synonymous. Exactly.
yeah,
Now,
yeah,
if you in the days of old, if you were a large brokerage firm, you would buy a seat on Wall Street. Bear Stearns would have a seat on Wall Street, and they'd pay hundreds of thousands, even maybe millions of dollars for it. Today, there's very, very few people in Wall Street. It's all computers. They still got some
uh-huh,
guys down there, and I know some of them, but it's all now done from here.
yeah. I got
This is
you.
Wall Street.
Yeah, and if you're listening to this show on one of the audio platforms, Leon Malnik just picked up his keyboard to say that the stocks is all Wall Street, all done by computer. Okay, so here's another technical question for you. What is a stockbroker?
Well, it's a term which today is not used, but essentially, I am a stockbroker. Um, I'm an investment advisor. I deal in wealth creation. Um, it's just a word that's been removed from the lexicon and evolved into an investment advisor. But it's
Uh-huh.
synonymous. It's one and the same. You would sell
Okay.
stock. Stock, it's an equity or a debt. So you are
Mhm.
brokering in that business.
Okay. And you probably have already touched on this just then, but let me ask it again just to make sure that we're clear about it. What's a financial planner or financial advisor?
Right. Um, and again, there's a lot of gray which covers both areas. As the advisor in for my clients, they oftentimes come with me with everyday family matters regarding money, how to set up an educational program for the child who was just born so they can go to college, how to invest in a house, types of mortgages. These things bleed over from the buyings of stocks like Apple or AMD or Microsoft.
Mm.
They create the wealth there, but then it's a question of what do I do with it? What's the most efficient way? What's the difference between my Roth and my IRA and my 401k? And so the lines are not clear. I tell people, and I'm serious about this. Um, I do not like to make financial plans for my clients that are concrete. Why? two or
Mhm.
three later, 2 or 3 years later, everything has to change because the laws may change, the tax rates may change, inflation will change, your taxes will change. All of these things are fluid. So I believe in living in the real world. If you create enough wealth, you can deal with any number of possibilities. So my focus is primarily creating wealth for people, but
Mm.
it doesn't end there. It's only beginning there. And then people ask me about, all of these other, important life cycle events.
Got you. Right. Yeah. And just to repeat, I'm talking with Leon Malnik. We are asking a few technical questions, and I have one more for you. I've seen this before. What is fee only services or fee based services when one works with a financial planner or advisor?
Very, very important question. It's a relatively new wrinkle in the years of financial services that go back for over 100 years. Um, Everything had been brokers, and brokers worked in a commission based circumstances arena. If I
Mm.
sold you a product, if I bought you a product, there was a commission tied to that. If you bought an annuity, there was a commission tied to that. So the question then became, is that putting the client's interest first? Because there's greed in human nature. My children have socks that have holes in them, and I got to get them new socks. What am I going to sell you? The product that gives me 4% commission, or the product going to give me 2% commission? You're not going to
Mm.
know. You'll never know what we know over here.
Mm.
If I sell you a product, am I going to get a trail? How big is the trail? You're not going to know. In a mutual fund, all of these things can happen. So what evolved was fiduciary responsibility, loyalty to the client. Your interest must be served, not mine first. So that we have to eliminate greed. How do we eliminate greed? We have to get on the same side of the fence. So we charge a fee. So for instance, if I'm going to charge a fee of 1.5% on $100,000, it doesn't matter how many times I buy and sell. The fee is what is based on the assets that I'm managing. And I want your 100,000 to become 200,000. Because if I'm at 1.5 on 100, I'll at 1.5 on 200. You're making more money and I'm making more money. So I only want to bring to the table what's the best thing for you, which is to make more money So our interests are aligned. And I think that's the
Yeah.
simplest way of explaining fee and fiduciary responsibility.
Uh-huh. Yeah. I just want to make sure that because I heard you there loud and clear. You told us that your company is a fee-based company, not a fee-only company. Got it. Okay, but you mentioned a word. I said that was the previous question was my last technical one, but you mentioned a word. I can't let it go by. You mentioned the word fiduciary. What does that mean, fiduciary?
It basically means that I am tasked with through loyalty and to serve your best interest. I have to be loyal to you. I have to serve your best interest. I can't have anything in my life, anything that conflicts with those two things. Real
Mhm.
estate, other deals, other ways of making money, all of that, if I have those things, must be revealed to my clients so they know what those conflicts could be ahead of time.
Yeah.
And if they disagree with them, I either got to remove them or we can't have a business agreement because I am no longer an eligible fiduciary. I
Okay.
have
Yeah,
to my client's best interest.
yeah, I find that interesting. I want to come back to that because I'm going to ask you another question later on and ask about your fiduciary responsibility in that context. But before we do that, though, I'm curious about your approach or your strategies when it comes to investing. Can you help us out? And what I mean by that is that, do you shop for stocks or do you shop for companies in terms of your strategies?
Well, every company, if it's publicly traded, means it's listed as a stock.
Okay.
Microsoft is a company, but because it's publicly traded, it appears on the S&P 500 as a stock. And so essentially we're buying, when you buy a stock, you have a piece of the ownership that that stock represents to the numbers of shares outstanding. Um, if you buy a bond, then you're loaning them money. You're like a bank, and they're paying you back interest. And at the end of the term, be it a year, 5, 10, 30 years, they got to give you back all your money. One is a debt instrument, one is an ownership interest. And it depends what my client's needs are. If you're an older person and you want to have income and stability, you've created your wealth, you're not worried about, you're not wanting it to grow, you're happy with what you have. Let's say you have $1 million, you want to draw income. So we may well look at a debt instrument. It doesn't go up a
Yeah.
lot. It could go up. It doesn't go up a lot, but you get a nice dividend. On the other hand, if you're looking to build and create that wealth, you're going to look for the equity, the growth. Now, some do both. So if you buy an oil pipeline, it's like a a road going down the New Jersey Turnpike with tolls every 20
Mhm.
minutes. Well, the oil pipeline has to pay those tolls if they're going from Alaska down to the Permian Basin in Texas. Well, if you own that pipeline, you have a piece of stock of that pipeline, and you're an old guy and you want income, you can get 7%, perhaps.
Yeah.
And so there's a myriad of ways, once you understand the market, to use the market in your best interest. So it's important for me as the fiduciary to find out what is my client's risk profile? What is their
Yeah.
tolerance to risk?
Yeah, yeah, and I'm going to ask you more about that in a moment. But I want to go back about companies. You mentioned Dell earlier. Now, you and I are men of a certain age. Late 70s, early 80s. You know, uh,
Please, please.
yeah. But back in the day, though,
I don't feel a day over
Microsoft,
22.
Microsoft, Apple, Dell, all of those companies, had someone, and this is just your feeling about it. Had someone in 1980, for example, bought $2,000, $2,000, dollars worth of shares in Microsoft or Apple or Dell, and kept them until today, how do you think that would look for them, today?
Let me give you not an example, a
Mm.
fictitious example. Let me give you an actual example, okay?
Okay.
I have a client who I met, and not that far back because I wasn't selling stocks back then. I was mostly managing 401ks. But I sold. Someone came to me in 2014 with $125,000. She worked for a very, very large publicly traded corporation, and she was going to change her life, go home, live Midwest. And her mother was a client of mine. She said, talk to Malnik, and he'll take care of your money. So I bought for her a bunch of stocks, but I put $50,000 on Apple and $50,000 on Nvidia. It's
Mm.
2014. So the $125,000 today. What's interesting is this: she never bothered calling me. I would call her up and send her stuff. She just didn't. She just didn't care or forgot
Mm.
about it. Finally, I got her. It was like last June. Talking from 2016 to a few months ago, a couple of months ago.
Mm.
And when I got in touch with her on the phone, and it was late at night, I said, have you been looking at your statement? And she goes, I don't look at my stuff, Leon. I said, your $125,000 or 150, whatever it was, is now worth $3.2 million.
Wow.
She started screaming. She fell to the floor.
Yeah.
I go, you
Okay.
okay? She goes, yeah, I'm okay. I can't believe it.
Yeah.
When I met her, I
Yeah.
promised her, I didn't promise her, but I said, my goal for you is to make you a millionaire. And she laughed at me. If you make me a millionaire, Leon, I'll love you to death. All of this type of so not only
Yeah.
we give her, now we're working on four. I had no idea, nor did anybody else, that the bull market in technology would do what it did. And she was lucky.
Yeah.
She got the two greatest companies that there were.
Right. I mean, that's a powerful message and lesson for a person, let's say 21 years old. You're getting started today.
Anybody,
Okay, but
buy
yeah,
goods companies, leading edge companies.
yeah. Well, that brings me to this question then. What is a good company? I mean, what is a good company? Yes.
It starts at the top. It starts at the owner, the CEO of the company. That's what I
Uh,
like to buy into, his philosophy. Because, like a
uh,
captain of a ship, how it's run, like a general, like how it's run comes from the top.
mm,
Jobs was a genius. Um, Jensen Huang, I've been following the guy since 2014. First time I heard him speak, that's the CEO of NVIDIA. I said, this is the greatest mind I've ever listened to. He is an
wow.
absolute genius. And I put a lot of money into him, a lot of my
Uh,
clients' money into him. I always would what I would do is someone say give you $100,000, I put 10, 10, 10, 10, 10. I would put 20 on Nvidia.
mm,
And we've seen what Nvidia has done. It's gone to 800 and split 10 to 1, gone to 800 and split 10 to 1. And then it went to, recently, it went to 1200 and split 40 to 1.
mm,
So those people who've been on that ride with me are all
yeah.
millionaires now. And it's all they did was get on the right boat, take it to the right place, and give it. And don't. Here's the problem.
Mm,
I'm putting my phone up because if those you're not seeing this on a podcast. But what today children do, I'm sorry, not children, people do
yeah.
is they go on E-Trade, they go on Robinhood with their computer, and they learn how to trade. We're going to teach you how to trade. It's sexy, but it's not how you make money. It's going to
Uh-huh.
Vegas. It gets you excited, but you don't make money. You make money by
Yeah.
buying good companies and holding them a long time. And that's not
Yeah.
done on the computer, on the
Yeah.
handheld computer.
Yeah.
It's a
I see
slow,
that. Mhm.
year, day by day, slow process. And what
Yeah.
my part in that is finding those companies that will take you for that ride.
I got you. And a good company may be a good stock to buy, but just because you're looking for a stock, it's like chasing the right numbers for the lottery. Yeah,
No,
maybe,
not at
maybe not
all.
as bad, but yeah.
Not at all. To me, that's not the analogy you want to make because numbers are chance. when you begin to realize that there's statistical and fundamental analysis, and I use both. The statistical analysis are, as you can see around me, I have 10 screens with all these
Okay.
charts on them. And the fundamental analysis is reading the balance statements, the income statements, the understanding what the ratios are, profit and earnings and all that. When you begin to meld all that down, you create a situation where the odds are in your favor. You become the house.
Gotcha.
And
Got it.
it's not like, it's not a random thing. It's all about earnings. And we get those every quarter. And when we see what Wall Street expects, and when these companies exceed or do not make those earnings, we know those are the companies which are making money.
Gotcha. So what are your thoughts about startups, including startups in the field that you like, techs, startups?
I generally stay away from them. Now, everything I say has got an exception to the rule. It just does. I will pepper in a few startups with a couple of $1,000 on an account that could be 100 or so, because you never know. You might find something that beats the odds and grows. What I'd rather have are the large, big companies, and I'll tell you why.
Mm-hmm.
When it hits the fan, and the water goes out of the harbor, all the boats go down, but the big ones don't disappear, and they come back better. The stock market always gets better. Go from the 1900s to today, it's always getting higher. So people say to me, it's too expensive. If I look at Amazon's $171, or if I look at Broadcom, well, it just split. It was $1,600. I don't care about the price, because if they go up 10% or 20% in a year, the bigger price has got a bigger increase. There's a reason why those prices are what they are, and those companies are what they are. So I like the bigger companies because they don't disappear.
Gotcha. Yeah. Well,
and they're bigger for a reason.
Yeah, I got you. I know you don't have a crystal ball, but if you think about the turn of the late 19th century into the 20th century, IBM, AT&T, are there any companies like that today that maybe 100 years from now, they'll still be riding, flying high?
There's always going to be new companies taking over companies which are not managed or correctly and aren't seeing the change. Xerox, gone. Sears, gone.
Yeah.
And these were the biggest companies of their types.
Yeah.
And companies here today, are they going to be here tomorrow and being bigger?
Mm-hmm.
It's all about management. Is management seeing to, and what you see now from these big companies like Apple, companies like Microsoft, are they see these up and comers, and what do? They don't compete against them, they buy them. Merger and acquisition. And that's what the government comes in with antitrust, and there's antitrust now in a number of these companies, cases being developed that you're thwarting competition. And so
you're so right about that. About these companies, because who would have thought it that Sears would be gone, or look at, back in the day, Kmart was the thing. But gosh, Walmart today, it's just amazing how these things change. I want to ask you though about AI. So much talk is going on about AI today. Even medical doctors, surgeons use AI in surgery rooms. What about AI and investing? How does it work for you?
I'll tell you how it works for me. I think it is going to take the bull market that we had from 2008-9, since the prime meltdown in housing, and it went until COVID, which time everything started to stop because everybody stopped. And right after that, generative AI was discovered. Now, it's a game changer. It's probably, before AI, the most important development to mankind bar none, was electricity.
Huh.
Tesla. Tesla invented the alternating current. It was a big fight between Con Ed and Tesla. Con Ed won the contract to light up the fair in New York, the World's Fair, but Tesla understood really the deeper of the two alternating currents. That's what we have today by and large. And that changed mankind because electricity brought light and all of everything around electricity. Since then to now, we could say with the computer was the locomotive. All those things were incremental. But the greatest thing since then is AI, generative AI. And
Yeah.
that is going to have the greatest impact on mankind. So what is the backbone of AI? What is the thing that is you can't do in order to have AI? You can't work without it, and that's graphics cards. They're the things that crunch the numbers. They're the things at the heart of the data centers. And who does that? NVIDIA.
Yeah.
NVIDIA. Now, other people are going to try to do it, and they will, but they're the first ones out of the gate, and they're probably 10, 7, 8 years, maybe 4 years ahead of everybody else. There'll be a catch up.
Yeah.
It's like a bicycle race. The first guy goes out,
Right.
and then the pack catches him. But
Right.
so who is the pack? Who are the companies that are going to be the pack around AI? And right now, there's a dozen or so of these companies that are able to feed off it. We can see it in the medical. You mentioned medical. All of this that's going through the Food and Drug to get approved, which is a 10-year process, through AI, cell manipulation, all the experimentation. Maybe it could be a 2 or 3 year process. That's going
Yeah.
to be seen.
Yeah.
Seeing it in the
That's
military.
exciting. Yeah.
It is exciting. And then we're seeing it in the military. People say, I want to have AI, or I want to have high tech. Northrop Grumman, nobody even knows what it's because it's all secretive. They have the highest
Yeah.
AI. Government funds them. Palantir,
Wow.
companies that work with AI to make whatever it is that you do more efficient. So it's everywhere, and it's going to become more prolific, I believe.
Uh-huh. Yeah. Okay. So I want to switch gears just a little bit. And I want to talk with you about working with clients, how you, your team, your firm work with clients. And the first thing that comes to mind is you mentioned the word before, risk averse. And I said, when we come bring it back up, how do you go about evaluating a client's risk tolerance? How do you do that?
Great question. Um, and here's the greatest problem that I run into is many people don't know.
Yeah.
There's so much fear in the stock market that they remain frozen and they buy CDs or keep their money at the credit union, and to get 4%, which is taxable, and interest and inflation could be 4%. So they're going backwards, but they don't know what to do. They don't want to know who to trust, and they don't know where to start. These are the two things I hear. And so when I try to ask probing questions, open-ended questions about, what are your feelings towards these things, many of them don't have an idea, and therefore are, and I don't want to use the word derogatory, but they're ignorant of what finances do. You need to have risk in order to make money. You don't need to have out of control risk. But that the market you can lose, that's risk. There's volatility in there. But know this, the longer you're in, time mitigates risk. If you buy Microsoft today, 10 years from now, it's very likely if you still own Microsoft and it's going to go back to the price today that you bought it from. It's probably going to have an increase 200 or 300% times greater. So it's sometimes difficult to convey that to people. And so in many ways, I have to lead them and tell them what they need because they don't know what they need. Now, some people know very much what they want, and
Yeah.
and we can then better gauge how to, offer them the proper product lines. But a lot of people
Right.
don't. So I have to introduce things.
Got it. Yeah, you've already implied the response to this question, but I got to ask you because I think it's important. When it comes to investing, is there such a thing as one size fitting all?
I don't believe so. That's the reason I see. To me, um, diversification is protection against ignorance.
Mm,
So, and that is the opposite that we were taught. We're all, I'm talking to us too, me, the people in
mm,
my profession. We're told to diversify, rebalance, all of these, expressions. The man's mind is like a dog with a bone. He wants to gnaw and come in different ways. And in financial planning, we have very astute people, and they come up with very, very fancy ways of doing things, computer generated things. All you need is a handful of good stocks. All you need is a few of them. The Wizard of Wall Street. I mean, not Wall Street. I'm sorry. Berkshire Hathaway, Warren Buffett,
yeah, yeah,
probably
yeah.
the greatest
Buffett.
investor of our time. And if you look at what he's got five stocks. He got Pepsi Cola or Coca Cola. He's got Geico. He's got the railroad company CSX. He bought some Apple finally. He's got other things, but he's got five stocks. He don't need them. He just wants and he don't sell them. He holds them a long time. Look what he's got. One
Mm,
share of Berkshire
mm,
Hathaway,
mm,
$600,000. One share.
yeah,
Um,
yeah,
so it's buy a good company, hold it a long time. It doesn't have to be sexy. It's
yeah,
just a long road, and the key to it is adding to it, adding to it, adding
yeah,
to it.
yeah.
Pay yourself first.
Yeah, and you've said it because I was going to ask you about time, and you've just said it then. But you may want to underscore it here and consistency. One is buy, give it time, and the other is continue adding to it. Do you want to say more about the importance of time and consistency in investing? Over time, or you're good where we are?
Sure, sure. I use an expression a lot to my clients. I call it escape velocity.
Mhm.
Let's say, for example, and these are just examples, you're putting in $1,000 a month, $12,000 a year. You're doing it every month. In the beginning, it hurts. You didn't pay $1,000 to your account, and after
Yeah,
3 or 4 years, it becomes normal, like a mortgage, and then you can up it. Well, what you'll notice if you're successful, you got good quality companies, and they're growing. That what you're putting in is dwarfed by what the market is putting in. You may put in 1,000, they may put in 2,000 or 3,000. Now you've reached escape velocity. Now you want to put in more. You can't wait to put in more. You're laser focused on making more and more money. And you will, because time mitigates risk, and the
yeah,
cost of the stock 10 years ago is dwarfed by what the price is today after it's split,
yeah.
after the dividends have been reinvested. And now all of a sudden you're on the train. You're not looking at it.
That is so important. I tell you, had I known, well, like I kind of knew it like 50 years ago, but didn't really know it as I know it now. For anyone listening or watching, it's important to talk to someone like Malnik because, if you're starting at 21 and have good health and make it to 65 or 70, you'll be happy that you did. So I want to, one other thing I got to ask you though, about working with clients. Let's say that you got five individuals talk with you in one day. Do you try to tailor make their investment portfolio based upon each, of them and their unique circumstances, or do you try to do something else?
Well, generally speaking, I have a universe of stocks that I follow very closely, and I'm
Mhm.
throwing out ones and adding to it. But there's a certain number in that universe that I'm working with. And if you look at most of my clients, they will have like type of portfolios that are
Mhm.
on a growth phase. Now, those that are in a retirement, they'll be similar too, but there's two different vehicles here. One is
Mm.
preserving assets and living off the income. Others are trying to create wealth. But generally speaking, in a practical sense, I'm following certain companies. I followed some of them for years, decades even, and I have a good feel for them. And so I'll put those as a starting point in a portfolio, and then I'll add to it other companies. So if you bought a company from me 12 years ago, and another guy bought a company from me a year ago, the same company, um, and I want to get out, I have to take into consideration that one who bought it from me 12 years ago, because now he's got capital gains he's going to pay. And if he's made a lot of
Mm.
money, maybe he doesn't want to pay those capital gains. Maybe, even though it might not be as favorable as another company, the new guy doesn't have to worry about the capital gains. The old guy
Mm.
does. So it's not so much what's in there, but how are you going to treat what's in there with tax harvesting.
Mm.
So it's complex circumstances. Every one of my clients, I
Mm.
look at individual, and
Okay.
that's kind of the advantage than going to a big brokerage house where you got a young guy who's coming out of college and he's going to rebalance your portfolio and do all these things, and they're not tax harvesting or looking at you
Mm.
as an individual. I think
Got it. Yeah. Okay. So
we're a
I want to
boutique.
look. What's that? I'm sorry.
We're a boutique.
Oh, I got it. Yeah. Yeah. Sounds like it. So I want to continue to fine tune this discussion about investors because, let's face it, many investors are people who have jobs. They have jobs and they're investing in addition to that. So if you're working with, and I want to go back to fiduciary, I said I wanted to come back to it. Here is it. If you work with a client who is investing through with your company, it also has a job, and his company has offers a 401k, but is moving to another organization, be it government, be it some type of institution. They offer a pension as an option. So you have the portable 401k, and you also have the option of a pension, and you work with someone like that. What do you tell them? I mean, what do you suggest that they consider as they move from one employer to another?
I've had it happen many times, so it's a real
Oh,
life. What if? First of all, pensions are rare and few today.
yeah,
Because of the fiduciary responsibility of the pension plan and the life expectancy of their employees. When pensions were first developed, it was mostly for a male audience. They worked in a mine, in a factory. They retired at 65 and 72. They were dead.
yeah,
So it was a 7-year payout, and then that was it. The employer spot. Well, today people are living to centurions.
yeah.
How much money you got to put aside in that pension plan to continue those guaranteed payouts a long time? So pension plans are being closed faster than being opened. Nobody's opening pension plans today. But if you got one, you got a piece of gold. You got the gold ring because of what I described. The
Yeah.
responsibility is no longer yours, it's the employer's. Now, to dig a little deeper, most pension plans by employers are not fully funded.
Oh,
Why? Well, there's a pension guarantee organization like FDIC or SIPC, that if they fail, they will come up and pay. They're not going to pay dollar for dollar, but there is a guarantee. People don't
mm,
look at that. The other question about the pension when they're ready to leave is, are you going to take the annuity the pension offers you, or are you going to give the lump sum over to someone like myself and hope they can do better? And so with an investment and a payout scheme over the
mm,
years. That's the big question on the pension.
yeah,
Now, on the 401k side, when someone is leaving an employer, if you work for a 401k, very few employers, there are some big ones, but most employers will not allow you to do an in-service withdrawal. Sometimes a little bit of it, 10%, but most won't allow it. But when you're ready to leave, say your employer private, is an example you gave, to the government, wherever else you go, it's my
mm,
recommendation is you want to control your financial destiny. You want to take that pension, I'm sorry, you want to take that 401k and roll it over into an IRA and then
Mhm.
manage it. Now, you can manage it yourself. You can hire someone like me who understands
Mhm.
the process, a professional, and you pay the fee. You don't have to pay the fee at the 401k plan. So that's a new
Mhm.
thing, but hopefully your results will be worth the expense. Fees
Yeah.
only matter if there's a lack of performance.
Gotcha. Well, you've broadened my perspective on pension 401k, but you did say that if you got a good pension, that's gold. So anyway, I think that's worthwhile. What's an annuity?
Annuities are the most complex financial instrument made by man. They're made by actuaries, people who speak the language of math. And I sold my first annuity in 1981. There's been a tremendous evolution in annuities. And most people, I'm willing to bet, have very little understanding about the annuities they own. Now, I can talk to us for a whole nother podcast on just annuities, but let me just say this. Um, there has been an evolutionary change in annuities, a subset of annuities that are only marketed to registered investment advisory firms like myself, and they're an index type of an annuity. It's a great concept, and and what it does is it says on the downside, we'll give you a buffer. What does that mean? If at the end of the period, say it's a 3-year period, you're down 20%, we'll give you back your 20% so you can't lose a dime. If you're down 30% and the buffer's 20%, you lose 10%. If it's down 15%, you got a 20% buffer, we'll give you back all your money. That protects your downside. On your upside, we'll have a ceiling. If the market goes up, we'll give you up to 10%, 12% based on the index, the S&P 500. If you go for a longer period of times, we'll go up to 66%, which the market never reaches. So you have a ceiling and you have a buffer. This is the newest type of an annuity. I like it. And there's no
You
penalties.
like them? Okay.
I like it because there's no penalties.
Okay.
And
Okay.
so far we've been selling them now a couple of years since they came out, and because the market has been strong, people are making money. They're tax deferred,
Mhm.
so it looks like an IRA, and they don't give out payouts like the typical annuity, so you don't have that cost built into it. It's just a
Mhm.
growth animal, and so it's an alternative to a CD. For example, a client of mine has $1 million in a CD. And he was getting good money, 5%. Okay, that money's gone now because interest rates are going down, because inflation's going down. So I introduced this to him. I said, in January, when your CD rolls, you can do
Mhm.
this. At worst, you'll get back the buffer so you don't lose, or you can get the market, S&P 500. Last year, S&P
Yeah.
500 was 22%. That's pretty
Okay.
good.
Yeah. I got you. Okay. So do you also like, you
Now,
said you like the,
but let me
mhm.
say this. The older
Yeah.
annuities are expensive. Um, And they do a job. They give you a payout for the rest of your life. People want
Mhm.
that. So you got to look at these things to determine what's in the client's best interest.
Got you. Right. So do you think it's a good idea to allow, a person who invested a fund, be it a 401k or annuity or whatever, to roll it over into something else? Do you think that's a good thing, or do you think we should be stuck in whatever we got into?
You have to look at each individual circumstance to determine if it's in the client's best interest. I mean, if the annuity has a surrender charge, and many of the old style annuities of the past did, some of the money is 10 years. And if you're into sixth or seventh year, you can't explain to a client, no matter what you think it's going to do in the future, to take a hit of 3 or 4 or 5% up front. Doesn't make any
Right.
sense.
Okay.
So you just got to carefully analyze each situation so you give the
Yeah.
client the best opportunity to have gains.
Got it. Okay. I want to, one of the things that your firm emphasizes is the opportunity an investor has to build wealth. Now, so a lot of people are thinking, asking the question, is it really possible to build wealth in today's economy? How would you answer that?
Well, what I would say is I could sit down and I can show you an example of what the aggregate of my clients have done over the last 3, 6 months, a year, 2 years, 5 years since
Mm,
inception. You can see a bar graph. You can see what the S&P 500 is. You can see the results of my clients have enjoyed over the years. If you wanted to be one of those bars on that bar graph and have the wealth accumulated, those people, then you could answer the question to yourself. Yeah, that would be meaningful
mm,
to me or not. I
yeah.
can't tell you what tomorrow is. I can only tell you is the best place to make your money grow is in the market. Even with
Mm,
inflation, inflation affects the price of stocks too.
yeah.
So while everything is going up, the price of butter and eggs, the price is going up for a share of Apple.
Yeah. Yeah.
So it's the most sensitive thing to the market is the market,
Hmm.
and it's
Hmm.
it's it's always thinking ahead. You think you know it. It's a meat grinder. You don't know it because
Right.
they're looking into the future.
Right.
And
Yeah.
so that's just it's a day by day thing accumulated over years and very systematic approach to it. You'll create wealth. You can't
Right.
create it any other way. You can't earn it. You can't create wealth for yourself by earning it. Even
Yeah.
the heads of corporations are paid in stock.
Mm,
Why?
yeah.
They don't pay money.
Okay. Well, yeah. Okay. So I got to ask you this question because you said you started in the financial services industry by selling insurance and other things. Is insurance in your world today an important part of building wealth? If you were talking with a
No,
client, would you say, client has a couple of children, life insurance? What would you say about all of that?
no. Having done it, having seen it from the inside, peek at the little man behind the curtain. The answer
Yeah.
is no, because life insurance salesmen will try to create a aura around their product to say it's a great investment. It's not an investment. Same thing with the
Mm,
annuity salesman. It's not an investment. An investment is where there is no safety net, where you take on risk. You buy a company, you hold a company. If it's a good company, the stock will appreciate. When you buy a life insurance policy, be it a variable, be it a whole life, whatever it is, it's regulated. It can only go up so much, and it has tremendous expenses if you break it down. You buy a stock, there's no expenses. The only thing you have to pay is capital gains if you make a lot of money when you sell it.
uh,
And that's a good thing. People say, oh, I'm just going
yeah.
to pay taxes. Well, there's a reason why you're paying taxes. You made a lot of
Yeah.
money.
Yeah.
Now, the only
That sounds
place the only
good.
place to create in the market.
Yeah. Gotcha. That
Having,
sounds
having
great.
been everywhere, having done all of this stuff. And I still
Yeah.
sell people life insurance. And people come to me, and there's needs
Okay.
for these things.
Yeah.
Could be term insurance, could be permanent. It depends
Yeah.
on the circumstances. But I don't never try to couch it in anything but what it is.
You got you.
These are not
Got it.
investments.
Got it. Okay. Hey, you've already shared one client story with us, but I was wondering, could you share at least one more client story that gets you jazzed when you talk with this client about their success in the market before we go? Just one more story.
Okay, this is an interesting. I mean, every one of these clients I can pull out are interesting stories. I got clients that are 94, 95, 96. Amazing stories, amazing life stories and investment stories. But I'll give you this one. And I met a guy. I was doing a seminar with an attorney. He used to do
Mm,
like a dog and pony show. I talk about investments, and he talked about estate planning. He did a family planning thing. And from one of these, it was at some restaurant. It was someone said to me, "I'm interested in investing, and I want to start out with a long-term care policy." For himself. He was a single guy, ex GI. When I met him, he was
mm,
I want to say he was early 70s. Single guy. Only thing
Mm,
the greatest habit he had was investing. Now,
mm,
this guy, he was a tough guy. He bought this long term care from me, even though that wasn't how he met me. I mean, he met me talking about investing, and he said, "I'm going to let you invest a little of my money." Okay, so I invested a little of his money, and it was pretty good. And because of his age and the people he was working with, they started retiring on him, his other brokers. And I found that he had four other brokers. And so his account came to me with about $500,000, most of which I inherited. And then I found out that as he grew older, he started to get disabled, and I needed to put him into a nursing home. I say I needed because he didn't have anybody. He was single. He had nobody. He had two nieces and a nephew, and he was very, very suspicious about everybody. Didn't want anybody to take care of him. And so I found out that he had money in banks, and he had money at 12 different banks all over town. And I had to go with him, hand in hand in the banks, and we would sit down, and I wanted to remove them so I could send them to Schwab, who I was custodying my clients' monies with, where he had all his accounts generated with me. When I walked into the banks with him, and he was very shaky at this point. He was old. He was getting close to the end. The banks looked at me like I was some kind of elder abuser.
uh-oh.
They said to him, George, do you really want to really do this? And he would answer back, Leon, do we want to do this? And I was going, oh, come on, this is bad. And so then I called in his niece, one of the people he sat down, he got a will, he's going to leave it to her. I figured she's going to be a little gentler face. Same thing with her. You guys are stealing this guy's money. Anyway, we went to all these 12 banks, and we generated everything. I worked on his account, put him in a nursing home. He lived a few more years. He was just a great guy. And then when he passed away, I got his account from the $500,000 to $5 million. And
Wow.
when he passed away, it went to the two nieces and nephew. Their accounts now is close to $20 million.
Woo. What a story. That's a good one. Well, Leon,
It's just, it
I've
is
re-
just, it was, and they are the nicest people I've ever met. I mean, they are just
yeah.
amazing, and they don't even use the money.
Oh,
It's
that's
they,
awesome. It's nice to
they
have
will
it and
leave it
not,
for
not
their
need it.
family. It's
It's
become
it's nice to
generational.
have it and not need it, and to need it and not have it. So, yeah, yeah. But look, I really enjoyed my time with you today. Want to thank you so much for saying yes when I invited you to sit with me. Thank you.
I want to thank you too, Stephen. It's been a pleasure, really.
Oh, okay. Well, you've been listening to the Possibility Action Network podcast. Our guest today has been Leon Malnik, the chief strategist at Malnik Wealth Management. I'm your host, Stephen Middleton. Until next time, good day.
You are not alone. Just keep on, keep on, keep on going. Just press on, press on.